So I think the crypto industry is easy to move to the UK. So if the US screws this up, Coinbase will, sure, be a US listed company, but its main operations will be in the UK. Same for many of these businesses. And I think that's very, very interesting. Germany's already doing a good job with regulation. Switzerland's done a great job with regulation. France is trying to do a good job with regulation. France is pioneering Web3 via LVMH. Bernard Arnault is the richest man in the world. Louis Vuitton Moet Hennessy is one of the biggest companies in the world. That's a fashion luxury goods. They've embraced Web3. All the Arnault kind of siblings are all involved. The kids, they're all involved in Web3. And I think we will see more of the fashion brands and more of the industry based out of that.
Today we have the CEO of Real Vision, Raoul, sounding the alarm on what could be the end of the boom for the US crypto market. Pal points out that the crypto industry has the potential to move to the UK if faced with unfavorable regulations in the US. He also talks about the stance recently taken by SEC Chairman Gary Gensler and why we're seeing a major issue with regulatory clarity. We're currently seeing the ripple effects from the FTX collapse last November, and the coming weeks will be an indicator for how cryptocurrency will move forward in 2023. Let's get right into the latest interview with Raoul Pal. Before we dive in, don't forget to hit the like button and subscribe. It's a tremendous help for the growth of the channel and allows us to bring you more content just like this.
This is actually global liquidity. And now look at that fit. That fit is staggering. That fit is so good, you can't argue that there is not a very, very close ongoing relationship. And anybody who says, well, correlation is not causation, listen, you're missing the whole point. Tied in with global liquidity is equity markets. Now, when you say, oh, well, they print money and therefore money flows into stocks, is simply not provable by the volumes in stock markets. What actually happens is the Venezuelan situation where you debase the currency and the stock market automatically adjusts in price. And that's a phenomenon that you see when there's excess supply of money around. And you see it even in your neighborhood. You saw that houses didn't trade at this price, this price, this price. They went from here to here after the printing. That was the change of the valuation of house prices based on the redenomination of assets. So NASDAQ and global liquidity, now the GMI Global Liquidity Index is a combination of the G5 central bank balance sheets plus money supply and other measures. And it's staggeringly good. So therefore, if this is the key driver of asset prices, then all we need to know is what's happening to liquidity. So the next chart reveals a bit more about it, which is the chart of the year-on-year rate of change of that global liquidity index. So you can see global liquidity came sharply lower. That brought all financial markets down. The NASDAQ, being highly correlated and a leverage play, came down more, and crypto, which is even more a leverage play on liquidity, plus the adoption curve, as is NASDAQ, because technology adoption is massive right now. They came down a lot, but as that turned, so did markets turn. And this is where people are scratching their heads. I don't believe it. The market should be going lower. Can't you see there's a recession coming? Oh my God, can't you see that earnings are coming lower? Yes, 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 the market knows it all in advance, and it already is priced. And I've put that out many times that the markets are forward-looking, and there is this uptick in liquidity was actually forecast by our GMI indicator, our financial conditions indicator, back in March of last year, showing that we would start bottoming and coming up from this level. The economy will follow suit. We're probably in a recession now, and then we'll have the kind of final stages of the bottom of the cycle, and then it claws its way back up again and doesn't become positive, let's say, till the end of the year, where GDP growth is positive again. But we'll have unemployment staying very sticky and prices coming lower. This is the S&P 500 against the G5 central bank balance sheets. And this shows that this is a kind of a plot chart to show correlations. And we've got a correlation of 97%. So there is no argument liquidity is the key driver. You can argue against it. You may hate it, but it is what it is. So once you understand liquidity is everything, you stop worrying about all of the things that you think should work as a model. Liquidity drives everything, not your model, not valuations, not anything else. It's all irrelevant. And it took me a while to understand this or even believe in it, but now I've seen it, I can't unsee it. And that everything code I wrote in Global Macro Investor, which won't be really sharing publicly for quite some time, I think is the real answer to all of this.
Powell questions the SEC's decision on whether or not Ethereum should be classified as a security. He also suggests that the UK is well positioned to attract crypto businesses due to its financial system, democratic values, and trade linkages with the world. He believes that the UK has a history of regulatory arbitrage, where it takes advantage of regulatory differences between countries to capture market share.
Crypto regulations, we've seen Gary Gensler today, Telt Show, being questioned about is Ether security, all of this stuff, refuses to say anything. I think the questions asked were pretty right, is why can you not give guidance to people? Do you want to drive away innovation from the United States? And I think the UK is almost uniquely positioned to take a lot of the crypto businesses. We saw Brian Armstrong from Coinbase over in the UK talking to the government, and that is not the only organization that's been over there. And we've seen this before. England has one great trick. It has an incredible financial system, democracy, and they speak the English language, and they have great trade linkages with the entire world. So when the US stumbles, particularly in financial markets, the UK picks up the slack and does something called regulatory arbitrage. It happened really predominantly first when the US came off the gold standard and had capital controls, because they wanted to limit the flow of dollars in this new world. The foreign exchange markets became the new market in town, because before that everything was pegged to gold. And the UK captured that market. It became the largest market the world had ever seen. Then the next phase was the US restricted bank lending, or lending to foreign counterparts. And the UK picked that up and developed something called the Eurodollar market. The Eurodollar market is the offshore lending of dollars. It is the largest lending market on earth and is gigantic. Hundreds of trillions of dollars. The FX market trades trillions of dollars every day. And then after that came another little trick from the UK, which was they saw that the US bank regs didn't allow for the use of capital in derivatives in an efficient way. So it was impossible for US banks to get involved in derivative markets. So the UK changed their banking rules. And they changed their banking rules over something called Big Bang. The Europeans followed suit, and the entire derivative market outside of the futures market. So we're talking about the really big markets, the swaps, the OTC markets, all went to the UK, where the UK became the epicenter of everything. All the US banks at this stage, over the 90s and 2000s, after Big Bang, which was the deregulation of the banking industry in the UK, everybody moved to the UK to set up business. So Goldman's main office, London. JP Morgan's main office, London. Morgan Stanley's main office, London. Merrill's main office, London. Credit Suisse, London. SocGen, London. Paribas, London. HSBC, London. Everybody went to London because that was the center of the global financial markets.
Lawmakers in the EU have approved the world's first comprehensive package of rules aimed at regulating the cryptocurrency industry. In a vote yesterday, the EU Parliament passed the Markets in Crypto Act, a legislation which seeks to reduce risks for consumers buying crypto and means providers can become liable if they lose investors' crypto assets. The rules will impose a number of requirements on crypto platforms, token issuers, and traders around transparency, disclosure, authorization, and supervision of transactions. Platforms will be required to inform consumers about the risks associated with their operations, while sales of new tokens will also come under regulation. Many analysts predict that we could be seeing similar regulation in the US as early as this year. What do you think about Raoul Pal's prediction for the crypto market and where crypto regulation is headed in 2023? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.